Thank you, Tom, and thank you, Kallanish, for inviting me to speak at the Asia Steel Markets Conference. I'm going to be talking today about the steel raw materials markets, but first off, we'll have a quick look at the steel market as well. Of course, steel prices globally doing extremely well. Asian prices no different. And at the moment, we've got a lot of question marks exactly over what's happening in China with steel production, with environmental restrictions, with the export story as well. Certainly a lot of interesting issues in the Chinese steel markets, and prices just seeming to go up and up these days. So starting off on the environmental side, there have certainly been a number of issues well covered in various media. Started off with the MIIT talking about trying to reduce steel production this year. That's something we think very difficult given the backdrop of strong steel demand and rising export demand. Then we've also had the environmental localized issues in Hebei, especially Tangshan, specific cuts in that major steel producing region as well. So they are having some impact at the margin, but I do believe that impact is somewhat overdone in terms of the market's expectations. And the second issue, of course, the steel export rebate cuts. Steel exports from China, of course, doing extremely well through the first quarter. I think we saw March exports at 4-year highs because global steel demand is recovering well. Global prices are doing very well. And of course, that's allowing the Chinese steel mills to increase the export business. But Beijing clearly talking about trying to restrict steel prices, reduce steel production, and therefore steel exports perhaps not so welcome among some quarters. But we've heard these rumors about reducing the export rebate since the start of the year, but still so far we haven't actually seen anything acted upon, although by the time the conference is on, perhaps that will have been announced. So it's steel exports, steel prices doing well, production we do still think rising. That of course will mean stronger demand for the steel raw materials, but we do believe that the supply is actually quite plentiful. So iron ore prices, especially today, at extremely high levels, similar to what we saw in 2007-8, 2011-13, but the market situation today somewhat different to what we had back then. So we don't think those iron ore prices are sustainable. So in terms of the impact of the environmental cuts, certainly we see the blast furnace utilization rates in China have been unusually weak for this time of year. Of course, you always have reduced production over Chinese New Year, but we then tend to see a very strong recovery as demand goes into peak season in the second quarter. But so far that's not been happening because some of the blast furnaces, certainly in Tangshan, have been reduced. We reckon about 1.7 million tons of lost pig iron production in March alone, and for the year as a whole, that could well be over 20 million tons. But it is very localized. So of course, nationally, with steel prices and margins where they are, we're seeing very strong steel production. So especially from the EAFs, EAF production running at extremely high levels now, and steel production in other provinces which are less environmentally sensitive is also growing very strongly. But nonetheless, the story, everyone seems to be believing in it at the moment, and it's certainly helped steel prices and steel margins to do very well over the last couple of months. So you can see their steel margins today, very, very strong going into peak season Q2. Obviously, we at SMM do track these daily transaction volumes, rebar, wire rod. You can see there very high levels as well. So the demand certainly has been doing well out of Chinese New Year, and we are coming into that peak season for construction. Now you can see here for rebar, normally the peak demand every year is around May or June. It's 2Q, good weather, that's when construction activity is at its peak. So we've clearly seen through March into April, absolutely output is lifting, but perhaps the trajectory on that output not growing quite as strongly as some may have expected, given the general bullishness around the Chinese macro outlook. Equally, HRC more variable through the year, but that is clearly doing quite well at the moment. The auto markets recovered very well second half last year. Appliance demand, export demand, all driving that market very strongly. But the issue is that we are heading into peak demand from the construction side in the next couple of months. Now, one key driver of steel prices, of course, is the inventory moves. That's generally one of the key factors the market participants look at to see how tight the market is. And you can see here that inventory pattern despite the steel production cuts at the margin and despite higher steel exports, the inventory draw that we've seen, especially in rebar, is not really substantially different to the historical trends. I'd say, if anything, it looks quite in line. So does that mean that actually the underlying demand is perhaps not that strong? The fact you'd have thought, if steel production is being restrained to a degree and the exports are doing well, surely the steel inventory draw should be happening much faster. And given the price action, that's kind of how you'd feel the market is. It's certainly been the expectation. But in reality, we're actually starting to become a little bit concerned. Maybe steel inventory is not drawing that strongly. And as we move past peak demand season, May, June time, perhaps the market will start to worry that actually that steel demand is not performing as strongly as people were thinking at the start of the year. Of course, the thing that is doing very well is the steel exports. So steel exports out of China in March at 4-year highs there. This was a big swing factor for the Chinese steel market last year, the way that we saw China actually importing steel with weak ex-China demand. And its net exports, 50 million tons in 2019, dropped to only 15 million last year. But we're already, for the first quarter, we're annualizing back above 40 million tons. And given the strength in global steel prices and ex-China steel demand, I do think that the exports will continue even if China does reduce some of those export rebates. So one other issue which we think it will make it very difficult to reduce steel production this year is that actually there is a lot of new steel capacity coming online. So one of the issues we saw obviously last year was the last year of the 13th five-year plan. This is now the first year of the 14th five-year plan. So there was a lot of blast furnace closures last year to meet the targets for the end of the 13th five-year plan. And this year, we're starting to see a lot of the new capacity under all the replacement programs starting to come on. So we have 120 million tons of new steel mills. Over 20 million of that is EAF capacity, around 100 million blast furnace. That is replacing around 100 million of old capacity, which will still be closing this year. But we have actually had a lot more capacity closures the last couple of years already. So that's why we do think it's very difficult for Chinese steel production to be down this year. Demand, even though it's a bit weaker, it's still going to be positive for the year as a whole, especially with the low base effect for Q1. Exports will be up this year, so steel production in China has to be higher this year. We're expecting about 5% growth. So when we turn our attention to the raw material market, in terms of the iron ore market, we do expect iron ore seaborne supply to recover very strongly this year. Now, I think it's been well flagged that there's very little supply growth coming from the majors. Certainly the Australians had very strong production last year. There's not a great deal of growth from the majors there. Obviously in Brazil, Vale will be recovering through the year, continuing that strong performance they had second half last year. But the key is at these prices, we're seeing a lot of that non-traditional supply coming into the market. India had very strong exports again in March. We believe 1Q total iron ore supply growth was about 40 million tons year on year. So yes, the major supply may not be growing, but at these prices, you're getting a lot of alternative supply coming into the market. Chinese domestic mines as well, obviously always restricted over winter. Most of the domestic iron ore mines are in the north of the country, subject to weather disruptions, etc. Coming out of winter now, we're starting to see the domestic mines increasing their production. And of course, the domestic iron ore, very, very profitable at these levels. There's very little of the domestic mines, which have a cost anywhere above $100. So at the current spot prices for iron ore, very attractive for them to be producing. So that will keep increasing as well. So one key indicator a lot of people focus on, of course, are the port stocks for iron ore. They were very low middle of last year. That was showing that extreme tightness in the iron ore market with Chinese steel production doing well and all the supply disruption that we had globally in the first half last year. But that has been recovering since the second half of last year and more recently, first few months of this year, ports inventory very clearly trending higher. Now that's happened at the same time as ex-China steel production has been increasing strongly. We've already seen production in Japan, Korea, Europe, etc. Other major iron ore importing markets has nearly fully recovered now. So those markets, of course, have been taking more iron ore away from China. But even with that backdrop, we've seen the Chinese iron ore imports first quarter this year up 8%, and the port inventory continues to build. So it doesn't really feel like iron ore is actually in that much shortage at the moment. There is plenty of iron ore around. The question is, do we have the right types of iron ore that the steel mills are demanding? Because obviously with margins very good, with the environmental pressures to keep emissions lower, increasing productivity, of course, that does give the steel mills a bias to chasing higher grade products. They want direct charge, pellets, lumps, and they want higher grade material as well. So what we are seeing is a clear pattern in the iron ore market since the end of last year, and something that we think will continue through this year is that iron ore prices, we will see higher premiums for the higher grade products. That is also assisted, of course, by the recovery in ex-China steel markets. Japan, Korea, Europe take a disproportionately higher share of the higher grade direct charge material. So that will also contribute to the higher premiums. But overall, we do think that even as iron ore prices soften through the remainder of the year, the actual premiums can stay at much higher than historical levels. Now, one other important data factor that we look at when tracking iron ore markets is the difference between the spot seaborne prices and the domestic prices. The domestic iron ore market is somewhat more liquid, has a lot more transaction volumes, and the prices tend to move a little bit more slowly. So it's interesting to see that actually in the last few weeks, we've already seen a bit more weakness in the domestic iron ore markets, while the seaborne prices, of course, continuing to hold up at the 160, 170 level for the 62% material. So that's just a sign, again, that we do feel that actually iron ore supply is quite plentiful, and the benchmark level material, 62% Fe, starting to weaken. So you can see here those spreads between the 65s and the 58s, of course, very wide at the moment. And a lot of the supply growth as well is at the lower grade area, places like India, etc. In non-traditional suppliers increasing their exports at these prices. A lot of that is lower grade material, so just adding more pressure to that market. It's also worth mentioning the scrap market as well. Scrap prices have certainly underperformed the iron ore prices recently. You can see here the comparison scrap versus pig iron at a huge discount at the moment, and that's why the EAF production at the moment in China is ramping up very strongly. And we have 50 million tons of new EAF capacity coming through in China next couple of years. So we do believe scrap prices will be very well supported going forward. So even though we expect a lot of weakness in the iron ore prices as we move into the second half of the year, scrap prices should certainly hold up a lot better. And with the Chinese steel mills having that focus on emissions as well, again, maximizing the scrap usage at the blast furnaces as well will continue to be a factor, as we've seen since kind of 2017-18. So again, iron ore supply, some of the short run data there. The Australian export volumes are pretty much not substantially higher on last year, but they've obviously been running very well the last couple of years. You can see their Brazilian volumes first quarter substantially higher than they were first quarter last year when we had all the disruptions, but still tracking a little bit below second half of last year. And the Chinese import arrivals as well have done very well considering the ex-China recovery in steel production as well. Freight rates also very high. That's always a good sign for the Cape-sized vessels, that there's a lot of booking activity. We know the coal markets aren't so strong, so if freight rates are doing well, it must mean demand for ships for iron ore, forward bookings for iron ore must be very strong as well. So that's the iron ore market. So at the moment, we just think, yes, steel is doing well, but perhaps that's overshot for now. But the iron ore market, clearly the supply has already been increasing. Prices for iron ore seem to be chasing the direction of steel prices at the moment, but in reality, we do think there is plentiful supply of iron ore, and that should cause some weakness in prices going into the middle of the year. If we turn our attention to the met coal market and manganese as well, the other raw materials, the coal market certainly been in flux since the Chinese restrictions on Australian coal imports. That's obviously meant that other providers of coal, Russia, Canada, etc., getting prices closer to the Chinese onshore prices, while the Australian coal is struggling to price anywhere near that level. So one issue that we have is that for PCI semi-soft, Australia doesn't export a huge amount of that to China, so those markets are somewhat less affected. whereas it's the premium hard coking coal, where China was a big buyer of Australian coal, and the Australians just struggling to find alternative home to that. So yes, all of the non-Australian material diverting into China at the moment, but the Australian material, there's just too much of it, even with very strong steel production out of Japan, Korea, India, Europe. There's still just too much Australian material around. So until we see production cuts out of the Australian miners, which is very difficult with their take or pay rail contracts, then the Australian HCC prices are set to stay at a very low level while China continues to restrict the Australian imports, which, speaking to most participants in the met coal market, the general assumption seems to be that that policy is going to be in place for quite a long time. When we look at the domestic Chinese coke market, that has been easing a little bit since the start of the year. We've certainly seen supply recovering. One issue we had in the coke market causing a lot of tightness second half last year was that, again, with the end of the 13th five-year plan, there was a lot of forced early closures of outdated coke oven capacity. This year, we have about 75 million tons of new coke ovens ramping up, so the supply should be more plentiful. We think the coke prices through the year should therefore be trending lower. We've already seen the coke inventory having been rebuilt, the operating rates increasing. But that said, certainly the coking coal prices have been a bit stronger in recent weeks. We've got some disruption with the Mongolia border, more COVID cases there, and a few domestic supply issues just tightening things up in the short term. But overall, we think that the increasing coke oven capacity in China this year, increasing mine supply as well, will ultimately soften the onshore coke market through the year. Manganese, meanwhile, that's probably the one market that's been left behind in terms of the steel prices and steel raw material prices. Manganese prices there had a little bit of recovery in December with ongoing disruption out of African supply and Chinese traders speculating whether there could be Australian restrictions on Australian manganese exports to China. That never materialized. And equally, the African supply continues to run smoothly. So the Chinese port inventory of manganese remains at very high levels. Imports keep increasing, and that's keeping manganese prices at very low levels, which we don't see changing anytime soon. So that's it from me. There's my contact details on the screen if you want to reach out, and I look forward to discussing more in the Q&A session. Thank you.